Your tax return says that your business made $60,000 last year. So that's what you should use to value your business, right? Well, it turns out not exactly. If you're a small business owner, chances are that the actual number you should use is called seller's discretionary earnings, or SDE. SDE could be the single most important number for you if you're considering selling your business. I'm Ed. I'm a business broker and the founder of Sundance Financial. Today I'm going to walk you through exactly what SDE is, how to calculate it, as well as the mistakes that I often see business brokers and owners make that cost them real money at the closing table. In a nutshell, SDE is trying to answer one simple question. How much cash could a new owner draw from the business if they ran it at arm's length? In a formula, SDE roughly translates to EBITDA plus an owner's salary and benefits, plus personal and discretionary expenses, plus or minus arm's length adjustments. Now, there are three ideas that are buried in the definition of SDE. First, how much cash? Second, could a new owner draw? And then third, if they ran the business at arm's length. Let's unpack these one at a time. So the starting point for SDE is your pre-tax profit, specifically a version of it called EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So why is EBITDA so important? Basically two reasons. The first reason is that buyers care about cash flow, and depreciation and amortization are inherently non-cash expenses. The second reason is that buyers want to understand the cash flow of the business itself, independent of the financing and tax decisions that are made by management, which are going to be completely different under new ownership anyway. EBITDA gives you a clean picture of the cash that a business is generating from running itself. That's why it's the foundation of SDE. Now here's where SDE gets interesting. As small business owners, you'll often run your business to optimize for your own personal situation, and not necessarily to paint a flattering picture for a future buyer. That's rational, but what it does mean is that your tax returns don't necessarily represent what the business actually generates. The classic example is your salary. If you paid yourself $70,000 last year, that shows up in your profit and loss statement as an expense, bringing your net profit down. Another owner with the exact same business might only pay themselves $30,000 to optimize for their personal tax situation. That means that the business that they operate would have $40,000 more profit than the business that you operated. Again, this is the exact same business with different reported earnings. But here's the thing. Paying yourself a salary out of your own business is really just like shifting money from your left pocket to your right. The economic reality of the business hasn't really changed at all. So, to properly capture the total economic benefit that a new owner would receive, and to be able to compare across different businesses on equal footing, we'll typically add back the owner's salary to our SDE calculation. Similar logic applies to all the other personal expenses that you run through the business. That's things like health insurance, the truck you drive on weekends, your personal phone, meals, charitable donations, etc. None of those expenses are actually required to keep the business running, and every owner will make slightly different decisions based on their own personal situation. So to adjust for all of that, we simply add it all back to SDE. And that's exactly what the point of an add back is. It's a legitimate way of showing buyers the total economic benefit that the business produces. Now, the arm's length adjustment is one that people will often miss. A lot of small businesses will have sweetheart deals baked into them that wouldn't necessarily survive a change in ownership. Let's suppose your friend owns the building that you operate out of and charges your business $1,500 a month in rent versus a market rate closer to $3,500 per month. That's a $24,000 per year discount that a new buyer is most likely going to lose once they take over your business. To make sure that we adjust for this fact, we would reduce SDE by $24,000 in this particular example. On the other hand, you'll often come across the opposite situation. Let's say that your brother-in-law is on payroll at $80,000, but only really does about $30,000 of actual work. A new owner could replace your brother at a market rate of $30,000, and so in this situation, we would actually adjust SDE up by $50,000. So the principle here is really simple. SDE should reflect what the business would actually look like operating on standard market terms. That means no favors, no family deals, no cutting yourself a break, everything is at arm's length. At this point, I'll take a quick detour because this is a question that often confuses people. You'll hear buyers and business brokers talk a lot about EBITDA on its own as well. So what's the difference between EBITDA and SDE? The biggest difference is typically that EBITDA doesn't add back the owner's salary, whereas SDE does. That sounds like a small difference, but it does change the type of business that each metric is typically used for. SDE is the standard for small businesses, typically with under $5 million in sales, where the owner is still heavily involved in day-to-day operations. EBITDA takes over as the business gets larger. At about that $5 million sales mark, you'll typically have a professional management team in place. The business is also generally more institutionalized, which means it can run without the owner showing up every day. And because of the business's size, the owner's personal situation and their compensation has less and less bearing on the numbers. At that point, EBITDA becomes a much simpler metric to compare across businesses, so there's no real need to add back the owner's compensation anymore. Anyway, let me tie this all together with a quick example. Let's imagine a small service business and run through the formula. We start with EBITDA. Let's say the company has EBITDA of $150,000. And let's also assume that the owner draws an $80,000 salary. We would add that back to EBITDA under the owner's compensation bucket. Let's assume that the owner also runs $7,000 worth of personal vehicle expenses, $8,000 of personal health insurance, $1,800 of personal cell phone usage, and $3,200 worth of charitable donations through the business. We would add all of those expenses back to the personal and discretionary bucket under SDE. Let's also suppose that the owner is good friends with her landlord and pays about $10,000 a year in rent when the market rate is closer to $25,000. That requires an arm's length adjustment, and so we would subtract $15,000 from SDE because a new owner might not necessarily get the same deal. To sum it all up, SDE would be, in this case, about $235,000. Now I want to note a few things worth knowing just to make sure you don't get caught off guard. First, add-backs to SDE must be defensible. If an expense is actually something that a new owner would have to spend in order to keep the business running, it's not really an add-back. It's a cost of doing business. Some brokers try to stuff everything into the add-back column to pump up the asking price. Buyers and their lenders will typically see through this, and the minute they stop trusting your numbers, the deal is as good as dead. Second, SDE is generally calculated across multiple years. Buyers will typically ask for at least 3 full years of financial performance, plus year-to-date financials as well. One good year on its own doesn't really tell a buyer that much, so they're typically going to want to look at the trend. Third, SDE is not the same as your take-home pay. From that $235,000 in our previous example, a new owner would still need to pay themselves a salary, service any debt they took on to buy the business, and reinvest some funds back into the company. You should think of SDE more as the total pool of cash available and not necessarily just your spending money. So that's SDE. It's not your tax return, it's not your net profit. It's really like the total economic benefit that a business delivers to an owner-operator who's running it on an arm's length basis. If you want to go any deeper on this, I've written a detailed guide on my website that goes through everything step by step. I'll drop a link in the description below. I'm also going to be posting a practical video that shows you how to actually calculate your SDE. I'll pull out a real tax return and walk you through the calculations line by line so you can follow along at home. That's the practical companion to this video, so make sure you hit subscribe so you don't miss it. And if you want to talk through what your SDE looks like, or what your business might be worth, I offer a free, no obligation consultation. Just book in through my website. I'll drop the link in the description below. Again, I'm Ed from Sundance Financial, and I'll see you in the next one.